Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, I'm going to talk about how to easily pay off your credit cards using something called velocity banking. So if you've never heard of velocity banking, we have tons of videos about the strategy in this channel, and all it is a way to pay off debts using something called lines of credit as your main tool. Okay, and you might be asking, what's a line of credit? And don't be embarrassed if you don't know what it is, because I have a friend who owns a lot of real estate and he has no idea what a line of credit is. Okay, so all a line of credit is a financial tool where you can borrow money, pay it back, and use it over and over again. So you might be saying like, isn't that a credit card? Yes, a credit card is one type of line of credit, but there's also personal, business, and home equity. And again, you can watch this video, you can watch any of the videos in this channel to learn the strategy, but I'm going to go over in the most basic form. So some people like they freak out about having credit card debt, right? If you watch the Dave Ramsey show, there's always somebody who freaks out about having credit card debt. And what we want to do is just make it easily manageable and pay it off quickly, right? So if let's say in this example, we have someone who makes $5,000 of income and $4,100 of expenses, including all the debts, and we have $862 in savings. So I don't know about you, but if I was making decent money, like 5,000 a month, and I only had less than $1,000 of savings, that's actually kind of pretty good because most people don't even have $400 in case of emergency, but I'd still be freaking out, right? Especially with these three credit cards. And how much is that in total? $50,000 in credit cards. That's insane, right? Along with the mortgage and along with food, gas, insurance, and other. But with Velocity Banking, how would you be able to pay off these credit cards, your debts easily without really changing your lifestyle? So let's assume that we don't make more income. Okay. Now, making more income is fantastic, but I get emails from people, the audience, who are making great money. You might be making 6 grand a month after tax, 7 grand. I've seen it as high as 10 or 11 grand. I've seen it all. Well, maybe not all. Maybe I'll get to a point where somebody says I'm making like 50 grand a month and I'm paycheck to paycheck. Could totally be possible. Have not been there yet, but a lot of you have been emailing me that hey, I'm paycheck to paycheck and I'm making great money, right? So there gets a certain point where you make great money, and if you don't know how to manage your cash flow, you're just going to be broke, right? That's the simple reality. And so one of the things that we're going to do is be able to concentrate our paycheck into one place. We're using something called a line of credit, and there's various kinds, right? If there's personal home equity and credit cards, I'm just going to say we have access to a home equity line of credit, and we'll say it's maybe a $60,000 limit, right? I put 50, whoopsie, six, all right, $60,000 limit, and interest rate. I have a 10% interest rate, but I actually talked to someone today, and she told me she had a 5% interest rate at home equity line of credit, which is insane, right? But let's just say we have this is 10%, okay? And what we're going to do is we're going to just try to free up our cash flow. Now, we're going to do something that's crazy, which is zero savings. A lot of people, they see this, they freak out. Like I told my mom this and she freaked out. And, you know, if you look at my community feed for the channel, I have zero in my checking savings. Because why? I'm going to show you the velocity banking strategy. What you're going to do is put your entire paycheck into your line of credit and then take your expenses out and then rinse and repeat over and over again. That's how simple the strategy is. In fact, I think the reason why most people can't do it is because it's way too simple. That's the reason, number one reason I think most people can't do it. But let's just figure out a way to consolidate our debts and free up our cash flow. So let's do this. Let's move this $50,000 of credit card debt into what we call a home equity line of credit. And all a home equity line of credit is basically something kind of like a credit card, but based on the value of your home, right? Home equity. If you don't know what it is, look it up. Okay. And let's just transfer this. And now what's our cash flow? Well, let's go ahead and figure out our cash flow and what happens when we do that simple debt transfer of these credit cards. Guess what happens? These three go to zero. And what happens to our cash flow? Oh my goodness, we somehow went from under $1,000 to 2,300 in no time, right? Just by doing one simple debt transfer. And this is what we're gonna do. We're gonna put our entire paycheck into line of credit, expenses out, and then take out, and then this will go down by 2,300. Okay, so what we do to calculate the next month is H2 minus plus I2 minus our cash flow. So previous month's balance plus previous month's interest minus 2,300 right here, okay? And we have to go ahead and calculate the interest. So let's go ahead and do that. And if you don't know how the interest is calculated, they just get the average daily balance. So what you do is just take the averages of this month and the last month's, right? And then multiply it by zero point 0.1, which is 10%, and then divide by 12. Okay, and you get the interest for a month. Obviously, if you're borrowing money, you're going to pay interest. But here's the thing: we're going to use the full power of our paycheck to take care of two things, right? The minimum monthly payment, which is really not expense anymore, and then we're also going to minimize the interest because when we put our entire paycheck in, we're putting the average daily balance at its lowest, so we're going to pay less interest, right? And all we have to do is just copy and paste these formulas and rinse and repeat. And so we can see here that in month 24, which is really year two, we paid off $50,000 of debt, right? $50,000 of debt is paid off. And let's just put a milestone right here, 50K of debt in 2 years. Woohoo. So I don't know about you, but this is really exciting. And here's the crazy thing. With me personally using this strategy, I actually paid off my mortgage $58,000 in 1 year. It's really insane. I don't even know how I did that, but I just simply use this strategy. So there's an order of debts that you pay off. Credit cards are usually first, okay? And there's actually, I'll go over this in another video. But if you have like 15 loans and a mix of credit cards and debt, it could be kind of confusing. Which debts do you move to the line of credit? How do you pay it off? But this is why I love to show credit cards because most people are suffering from credit card debt and they're freaking out when I show them, hey, you could just move these to a line of credit and then use your cash flow to pay it down. Amazing, right? And then we paid this off in about 24 months. And now we would just essentially move on to the mortgage, right? So at this point, you have the choice of either just directly paying your mortgage with your cash flow. Now, would most people do that? Probably not, because most people have cash flow management problems. And if you don't believe me, look at the statistics as an average is about how long it takes for the average person to pay off a 30-year mortgage. It usually 50 something years because they refinance their home or property every 5 to 7 years. They get a letter from the bank saying, hey, you could get a lower monthly payment, or hey, you could pull out cash equity from your home and remodel your kitchen or something like that, right? And then they do that, and then they wonder why like it takes them 52 years to pay off their loan. And so one of the things that you can actually do is just transfer chunks of this to your line of credit. So let's say $5,000, and we'll just say that this is going to be 195K. Okay. If you ever look at a mortgage amortization chart, how long would it take you to pay off 5K of your mortgage? And it depends on where you are too. But let's just assume we're at the beginning. So calculator.net, 30-year mortgage. And I'm just going to take a look here. And, well, actually, loan amortization is actually better. Loan amortization. Okay, so we're going to go in here, and then we'll just do this 30-year loan, 6%. Okay, so now let's take a look at this. How long does it take to go to 200 to 195K, right? It's going to take us about almost 2 years, right? And if we've paid, let's say paid off all our debt after 2 years, what's the balance? 194. How long is it going to take us to go to 194 to 189, right? It's going to take us 2 years. And look at all the interest that we pay. It's crazy, right? So let's just do this. So right now, after 2 years, we're at 189K. Okay, 189K. So 189K. And then what we're going to do is we're going to subtract, let's just say $5,000. How long would it take us to get to 184K? Okay, so 184K. So probably a year and a half, right? Or probably, I don't know. Yeah, maybe about a year and a half. But let's go ahead and transfer $5,000 to our line of credit and see how long it takes us to pay that sucker off. So plus $5,000. Oh my goodness, it took us 1, 2, I guess 3 months to pay it off, right? So at this point, we just 2 more months of payments and then bam, something that was going to take us like 1.5 years, it just took us 2 months because we're using the power of our maximum cash flow. We're able to control our money, and we're also preventing something that I'm going to talk about a lot, called segregation of income, which I haven't actually mentioned in this video. But again, credit card payoff, so easy. Just move it to a line of credit and we're good. And obviously make more money, right? You want to change, because of inflation, you always want to find ways to make more money. And there's a saying that you're not worth what you deserve, you're worth what you negotiate. So you always have to negotiate for more money, whether it's for a job or just doing good real estate deals. All right, well, this is Korean Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google form link below, where we learn about financial literacy and other stuff like real estate investing. And I don't know if you're watch Seinfeld and yada yada yada. So I'll just say that way. But other than that, yeah, I'll just go ahead and crank out more videos. And believe it or not, if you've been wondering where I've been, I've actually been out of town, and I actually did a velocity banking presentation today in front of actual live people. And so they've been very receptive in person. They've been receptive online. So really appreciate all of you just watching and enjoying the material and making me rich through YouTube ad revenue. No, I'm just kidding. All right. Well, have a great day, everybody. We'll speak next time.